It is often the case that the underlying, which is the subject of the forward contract, particularly if it is a financial asset such as a share or a bond, has an income stream associated with it. For example, a share pays dividends and a bond, of course, pays coupons. If these so-called carry benefits, the dividend or the coupon or any other income stream associated with the underlying, are not taken into account, the principle of no arbitrage pricing will break down. To avoid arbitrage opportunities, the carry benefits have to reduce the forward price. And the reason that the carry benefits reduce the forward price are fairly technical, not super complicated, but you would need to go through a complete arbitrage exercise in order to demonstrate properly why the carry benefit, either the dividend or the coupon, must be taken into account as a negative. I think that is best left for a separate video. At this stage, we are going to accept fairly uncritically that the carry benefit must be a negative, and we are going to use that principle in the example in the screen in front of you. Let us enter what we know about the situation provided to us in the blue box. We have a spot price for the share of 250 Rand. 9 months away from today, that share is expected to pay a dividend of 20 Rand. And the forward contract in question has an expiration date which is 1 year away from today, and we are asked to determine the forward price. The risk-free rate that we have been provided is an annual rate of 8%, and we are of course going to be using that in all TVM calculations. Let us begin by considering the effect of the carry benefits. We know from the principle of cash flow additivity that we cannot take that 20 Rand and adjust it against the 250 because they are simply put at different points in the timeline. We need to bring the 20 Rand back to T0 today in order to make the necessary adjustments. So we take it back using the risk-free rate of 8% and the time period of 9 months as our exponent, and we calculate that the present value of that expected dividend today is 18 Rand and 88 cents. We then apply the principle that we have accepted fairly unquestioningly until we have looked at an arbitrage example about this, that carry benefits must be treated as a negative, and therefore we add a minus sign to that. Now that the numbers are correctly brought to the same point in the timeline, we can calculate 250 minus 18.88, and that number is 231 Rand and 12 cents. Having determined a so-called adjusted spot price, the final step is for us to calculate the future value of that amount, which of course will be our forward price. And that calculation is done by multiplying 231.12 by 1.08, and it is for a year, therefore there is no complicated exponent there, and the final answer for us is that the forward price is 249 Rand and 61 cents. And that is the no arbitrage forward price, taking into account the carry benefit represented by that expected dividend in 9 months. And that is the final answer.